One of the biggest myths in finance is that you need to be an expert on the economy to understand the market. The reality is that some of the most disciplined traders in the world almost completely ignore the daily news. Why? Because by the time you read the headline, the real story has already been told right here. So, what do they use instead? They operate on a powerful logical framework called technical analysis. And today, we are going to explore what that actually means. It's built on three foundational principles, and the first and most powerful one is this: the market discounts everything. The first and most important belief of technical analysis is that the market price accounts for all available information. It means that literally everything, and I mean all of it, the fundamentals, the economic news, the political nonsense, what some dude on Twitter is feeling about the market, all of that gets boiled down and is already reflected in the price you see on the screen. So how the heck does that work? It's super simple. Supply and demand. All that outside noise influences millions of people to either buy or sell. The price, at any given second, is just a brutal equilibrium point where those two massive forces, all the buyers and all the sellers, smash into each other. And here's the key: most of what people obsess over, earnings, interest rates, GDP reports, and employment numbers, even headlines, those are lagging indicators. Translation, they tell you what already happened. By the time that data hits the newswire, traders have usually already priced it in. Price is different. It's live. It's the crowd's immediate reaction, the running vote of millions of buyers and sellers, and when you look at volume alongside it, you see how strongly that vote was cast. The second foundational principle is that prices move in trends. This is the backbone of technical analysis. If markets didn't trend, there'd be no point in studying charts. Most of the time, price doesn't just whip around randomly. It moves in stretches, up, down, or sideways. And once the trend is in motion, it's more likely to keep going than to suddenly reverse. Think of it like physics. An object in motion tends to stay in motion until something strong enough forces it to change direction. Markets behave the same way. Once buyers or sellers get momentum, that force usually lasts longer than you'd expect. And here's the practical point. The whole purpose of charting is to catch those trends early so that you can ride them instead of fighting them. Most technical tools, trend lines, moving averages, indicators, exist to help identify and follow those trends. So principle number 2 is simple but powerful. Trends exist, they persist, and your job is to recognize them and respect them. The third foundational principle is that history repeats itself. Not because markets follow some mystical cycle, but because they're driven by people. And people, with their greed, panic, and overconfidence, react in surprisingly consistent ways. That's why chart patterns like head and shoulders, double tops, or support and resistance levels keep showing up decade after decade. They're not magic formulas. They're simply snapshots of crowd psychology written into the chart. And here's the important part. Since human psychology doesn't really change, the same setups and behaviors tend to repeat. The past leaves fingerprints that can help you read the future. So principle number 3 is this: markets evolve, technology evolves, but human behavior doesn't, and that's why history keeps repeating on the charts. So that's it. 3 big reasons why successful traders believe in technical analysis. Price reflects everything, price moving trends, and history repeats itself. These ideas go way back to Dow theory in the 1800s, but most of us learned them through John Murphy's book, Technical Analysis of the Financial Markets. He didn't invent TA, he just wrote the modern Bible that pulled it all together. And look, you don't need to take my word for it, or even Murphy's. The best way to fully understand these principles isn't just to hear about them, it's to see them play out on a real chart. I've linked a free technical analysis platform in the description where you can do exactly that. Spend time with it, train your eyes, and the principle will start to make sense in a way words alone can't.